Myths about Bitcoin. Myths and facts. In December 2017, the digital currency Bitcoin hit a record price of $19,665.39 per coin after having been launched by Satoshi Nakamoto in 2009. It further gained mainstream acceptance, and in late 2017, it was given its own futures market at a traditional brokerage firm. Perhaps because of its complicated technical design, a passionate community of advocates, and its famously mysterious founding story, its creator was unknown for years. A variety of widespread myths about Bitcoin have persisted. There is a finite supply of Bitcoin. Bitcoin has been described as digital gold because it is supposedly impossible to create more than the 21 million units already planned for circulation. Goldman Sachs published a research report stating that Bitcoin has a mathematically certain total supply. Modern-day gold bugs such as Ron Paul like the idea that no government can debase Bitcoin by increasing the supply. Yet there is no guarantee that the supply of Bitcoin won't change. The currency's original design calls for the 21 million units to be slowly created over the next 100 years or so. But the protocol can be amended by community consensus. A majority of participants in the Bitcoin network, as has already occurred several times, such as an update that helped users specify payment conditions. So far, the Bitcoin community has fiercely defended the planned finite supply and is notoriously change averse. But politics among users, not math, keep things that way for now. Those politics may shift if Bitcoin adherents come to agree with mainstream economists who say the currency will hit a deflationary spiral as Bitcoin are accidentally lost over time and the supply dwindles. Computer scientists also fear that the protocol will become unstable as inflationary rewards for Bitcoin miners who secure the system using tremendous computing power are phased out in favor of transaction fees. For these reasons, some newer cryptocurrencies have challenged Bitcoin's finite supply plans. Instead, they follow a digital version of Milton Friedman's proposal for low but constant inflation. Bitcoin users are anonymous. Nakamoto, Bitcoin's founder, claimed that the currency offers privacy. Since transactions are not listed under real-world identities, Bitcoin's blockchain, the permanent public record of transactions, uses cryptographic pseudonyms. Users can create as many free pseudonyms as they want, and most Bitcoin software generates a unique pseudonym for every transaction. WikiLeaks encourages donors to use Bitcoin because it's anonymous and cannot be easily tracked back to you. Harvard economist Kenneth Rogoff has even suggested that governments will eventually move against cryptocurrencies because of their anonymity features. However, the vast majority of Bitcoin users do not have a significantly greater amount of privacy than they would with traditional bank transfers, and they probably get much less than they would by paying with cash. This is because it's possible to link a user's pseudonyms together by studying patterns in the blockchain. Several blockchain analysis firms already offer their services to law enforcement. Furthermore, most users leave a paper trail when they buy or sell Bitcoin in exchange for dollars or other fiat currencies. As reputable exchanges services record identities to comply with Know Your Customer laws, the most technically savvy users can still hide their identities through coin mixing protocols, in which users swap coins with each other to jumble ownership patterns. These techniques remain difficult and sparsely used. Some Bitcoin competitors offer stronger built-in privacy, but these currencies are much less popular. Bitcoin is beyond the reach of the law. In Bitcoin's early days, it was the currency of choice for a multi-million-dollar underground drug market called the Silk Road, prompting critics like J.P. Morgan Chase's chief executive, France's financial market regulator, and Nobel laureate Joseph Stiglitz to claim that Bitcoin is a haven for those seeking to evade the law. Stiglitz said that it ought to be outlawed. Even Bitcoin's advocates sometimes say, as one analysis put it, that the technology is one step ahead of anti-competitive laws and unfriendly jurisdictions. Not really. New technology always requires updated interpretations of existing statutes and case law. In this case, originally written for other parts of the financial sector, and that gradually process is well underway for Bitcoin. Its exchanges are already regulated through specific laws in some states, such as New York, and by rules on money transmission services elsewhere. All mainstream Bitcoin exchanges at least attempt to comply with Know Your Customer laws to prevent money laundering. The IRS regards Bitcoin as taxable property. The Securities and Exchange Commission recently began cracking down on ICOs, a new type of blockchain based fundraising mechanism under its existing authority to regulate securities. The original Silk Road market has been closed, and authorities have managed to shutter numerous follow up efforts. Many other countries, most notably China, have moved aggressively to regulate or ban certain types of cryptocurrency business. Bitcoin wastes energy. Bitcoin mining is an energy intensive process. Anybody can become a miner, but he or she needs special hardware chips working constantly to solve the cryptographic puzzles that create new blocks in the Bitcoin ledger. In exchange for the rights to newly created Bitcoin, because of its decentralized nature, nobody knows the exact amount of electricity this process consumes. It's likely to be several gigawatts at any given moment, roughly equal to the output of a massive power plant such as the Hoover Dam. No wonder observers have lamented Bitcoin's environmental impact, with reports that individual transactions use as much energy as a home uses in a week, or more hyperbolically, that Bitcoin will consume all of the world's electricity within a few years. However, let's compare the overhead for various currencies. Banks pay for security guards, among many other security expenses, who often merely stand around watching the customers. We don't think of this as wasteful because without guards, theft could undermine the entire system. The same is true for the raw power used by Bitcoin miners. We don't yet know how to secure a decentralized ledger like Bitcoin's blockchain without the energy-intensive mechanism. There's an open scientific argument about what level of energy expenditure, as dictated by the revenue earned by Bitcoin miners, is necessary to secure the system. If research on low-energy methods pans out, Bitcoin can change or be replaced by a greener competitor. Until then, this is an essential cost for the currency. Bitcoin will replace credit cards and cash. Many early Bitcoin reporters, such as Kim.com, creator of the Mega Upload file sharing site, predict Bitcoin will overtake other payment schemes. In 5 years, if you try to use fiat currency, they will laugh at you, says major Silicon Valley investor Tim Draper. But Bitcoin does not yet have several key properties needed for a universal payment mechanism. First, the design currently limits the system to handling only a few transactions per second, nowhere near the tens of thousands that credit card networks can handle, nor the tens of thousands more done in cash every second. The community has worked for years on various plans to improve Bitcoin's capacity, but there is no agreed upon path forward. Second, Bitcoin transactions, once free, have become increasingly expensive, with fees now averaging $20 and reaching as high as $400 based on demand. Developers are working to improve capacity, but for now, the trend is on the upward swing. Finally, Bitcoin transactions do not take effect immediately because of the limitations of the blockchain. New transactions are added only every 10 minutes. On average, when users desire extra security, they can take more than an hour. Even with planned improvements, it's unclear if the technology can ever become a universal payment system. Bitcoin is more like a reserve store of value, akin to gold bullion or treasury notes, than a day-to-day tender. Bitcoin is a scam and a Ponzi. I don't remember how many times I have heard these accusations, and the reasons often given with these baseless arguments are mostly: founder Satoshi Nakamoto ran away. Satoshi owns 1 million Bitcoins. People have lost money. Wild volatility in Bitcoin markets. Bitcoin is not backed by anything, etc. When people are afraid of a new concept or one they don't understand, fear and accusation are often an initial reaction, especially when it comes to their belief systems around money. The people who say all these things don't understand much about decentralization, free market economics, or intrinsic value. People will lose money if they are gambling or trading. Bitcoin markets are free markets, and this asset class is the most uncorrelated asset class we have seen up to now. So if you gamble and trade, you will win and lose. To the claim that Bitcoin is not backed by anything, do we know what backs our national currencies that are annually inflated, even up to 13,000% inflation, like in Venezuela? Sorry, but those who think Bitcoin is not backed by anything are mistaken. Bitcoin is backed by its math, its censorship resistance, a dedicated community of users, and decentralization. Bitcoin only funds illicit activity. Bitcoin was initially used for many illegal activities and was known for its use in transactions on the Silk Road dark marketplace. Later, it was also used by WikiLeaks, the famous whistleblower in the world, when all the banks stopped supporting them. But no one talks about what happened after that. These two accusations actually pushed Bitcoin towards mainstream adoption. People started using Bitcoin for buying pizzas. Why does no one talk about that? When all these activities, illegal and legal, are done throughout the world using fiat currencies, there are no voices raised and no questions asked, nor do we think of declaring fiat national currencies as being a fraud used for illicit purposes. Bitcoin is costly, and I can't afford a whole Bitcoin. Enough of this narrative. Bitcoin is costly and I can't afford it, so let me pick up some cheap Ripple and Cardano, etc. Well, that's not how it should be. If you are into buying cryptocurrency for investments and don't own Bitcoins, you are missing out. However, it doesn't mean you shouldn't buy other coins. But the narrative of cheap and costly coins is simply unfounded. Many people think that they need to buy a whole Bitcoin, but that's just not the case. Bitcoin is divisible down to 8 decimal places, so you can buy a lot of Bitcoin fractions with whatever money you have. The smallest unit is called a Satoshi, and you can buy many Satoshis in smaller fiat increments. There are guides you can look at for reference to understand Bitcoin divisibility. But what is a Satoshi? Satoshi to Bitcoin and USD converters, etc. By keeping 50 to 60% of your money in Bitcoin while you purchase other coins, you will not go wrong in the long run. Also, keep your coins safe in a hardware wallet like a Ledger Nano S, a secure hardware wallet. Do your research and don't fall for cheap coins just because they are cheap. It is very likely that many cheap coins might not see another day. As a disclaimer, this information is intended for educational and training purposes only and should not be construed as investment advice. As with all financial decisions, you should contact your licensed financial advisor before investing in any financial instrument.